In the world of business and personal finance, an audit letter from tax authorities can induce anxiety and disruption. Yet there are common triggers that often lead to such unwanted attention. Understanding these triggers is the first step to avoiding them. Here are 4 audit triggers you should steer clear of, whether you're managing company books or filing your own taxes. The first trigger is inconsistent or significantly fluctuating income from year to year. Imagine a small business owner, Amanda, who reports a sudden massive spike in income with no clear documentation or explanation. Tax authorities use algorithms that flag files where income stories do not add up or match industry norms. Amanda finds herself in an audit because the numbers she reports wildly exceed what is typical for her business category, suggesting possible underreporting in previous years or errors in the current return. Secondly, excessive deductions or expenses compared to your declared income can set off alarms. Take John, a freelancer, who claims home office, travel, dining, and supply expenses that amount to 90% of his declared revenue. Auditors look for deduction patterns that are not in line with similar businesses or professions. By exaggerating his deductions, John inadvertently draws scrutiny as his lifestyle appears unsustainable based solely on the income he reports. The third common trigger is mismatched third-party records. Think of Maria, who receives several 1099 forms from clients and a W-2 from a part-time job. She mistakenly forgets to report one of her 1,099s. The tax authority has records from both senders and compares them to her filing. The mismatch triggers an automated audit as her reported income does not coincide with what payors have filed. Always ensure your records match what's reported to authorities. The fourth trigger is the use of round numbers and a lack of documentation. For instance, if every expense that Tom, a real estate agent, claims ends in zeros or fives and he submits no receipts, this suggests estimation rather than precise bookkeeping. Auditors are trained to notice patterns that indicate guesswork. The absence of proper documentation only strengthens the suspicion. In conclusion, to minimize audit risks, present consistent and reasonable figures, claim deductions that are both legitimate and proportional, ensure your data matches third-party reports, and keep meticulous records. Avoiding these 4 triggers not only reduces your chances of an audit, but also promotes sound financial habits.